innovations. I'd like you to take out your phones or notebooks and help us do something. I'd want you to check this for our homework. So what after all the innovations? Yeah. So what after all the innovations? So that's our take home. That's our homework today. And to help us answer that question partly, is technology really helping us to take finance to those who need it most? Is it helping us to manage default risk sustainably? And is it also helping us to protect our institutions and our clients better? So my first question goes to Lucy. Kenya's digital credit market hit 1 trillion in 2025. What are the top 3 innovations for accessing credit for the unbanked?
Let's give it another go. Fantastic. Good afternoon, guys. Good afternoon. I know we're exhausted, it's been a long day, but I think we've got to applaud ourselves for being able to see through a full day of knowledge. So Gloria, it's honestly an interesting space for us to be on the panel after everything we've had today, and I also like what the last presenter was presenting because it attributes to this. This over 1.2 trillion that we're speaking about is contributions that everybody in this room has had a role to play in, whether you are a traditional banker working in the FSP sector, whether you're a fintech, whether you're a telco, or whether you're in the advisory space like myself, or you work with all these stakeholders to develop digital lending products. So what we've seen first is strategic partnerships among the ecosystem players. I think that's the biggest contribution. Like before, when lending was a closed-loop circle with just the banks playing a part in, I think Kenya in the region has been a leader in that. Over 50,000 digital lenders have been approved, so that's a big one. I think the other thing is what Dennis has been speaking about the whole day, which is the data piece, and we see the implementation of AI, machine learning, to help us improve our credit scorecards. So we've seen a transition from traditional scorecards. I remember way back, and I've seen my Standard Chartered colleagues here, when I was in banking and we used to do appraisals using traditional scorecards. But now we are all embracing alternative data in our scorecards and using whether it's robotics, genetic AI, just to improve our appreciation of the personas that we are giving these loans to help in the financial inclusion space. I think the other item I can look at is the informal sector, and Mr. David is here. I think him and his team are doing a fantastic job in that space. Is when you look at whether it's the SACCOs or the P2P space where we have the chamas and being able to bring them into the financial space. That's a big game changer in our day and age, because if you remember, those of us who grew up in the 90s, it's all table banking, but now we're seeing these groups being brought into the digital ecosystem. I really appreciate that, and I think that's going to play a big role in the next frontier for digital lending.
Okay. So if I'm a customer in Moderator, which is Canada, or even for courts, yeah, which of those will reach me?
I can say something and something David can contribute. First of all, I think, again, fantastic space we're in as a country where we see digital lending. I mean, move across just the East African space, and it's a different scenario. But I think the way to attack is to go vertical wise, right? Because then if you go through verticals, you're able to customize your scoring to these verticals. So for instance, one of the last miles that we all have difficulty in is agriculture. The only way to be able to serve that last mile farmer in the village is through verticalized scorecards. And I'll give an example. I have a customer in Ethiopia. They do fantastic fintech working with last mile farmers, just very small scale farmers. And so one of the pieces of work we've done with them is be able to take the traditional scorecard and then bring in the variables that are purely in agri in the vegetable value chain. and you put those attributes into the scorecard, and then using machine learning and AI have been able to see which variables give us the best output for repayment. So we're hedging of the risk that traditionally makes people shy away from the agri sector. So just one example, David and Sam.
Thank
you very much for the great questions. From where we sit as a microfinance bank, let me start by saying that the banks in Kenya, when you look at what we are discussing now, we still have a lot of challenges, especially in terms of this digital space. We have legacy systems that still exist, especially in the microfinance space, the microfinance bank space. And that's why we find the banks have not taken advantage of what is happening over the last 5 years. Out of 14, only about 4 microfinance banks are making a profit. And that tells you a lot in terms of the business model. So in terms of how do we reach our customers out there, somebody in Tok or in Mandela, how do they consume our services? Definitely it's about the bank itself and how prepared they are. In Caritas, 99% of our transactions are digital. 99%. I mean, we are a deposit-taking bank. So that tells you a lot about what we are doing and how it means that you can be able to open an account. You can be able to open an account from wherever you are in this country. Whether you're in your Tok or you are in a village somewhere else, you can be able to open an account. And there are various products that lie along that proposition. But the challenges are many from where we sit and from where I sit at different angles. The issue is no longer inclusion. And that is what we are doing as a bank, to ask ourselves, is inclusion enough? Over 80%, let's say 85% to be precise, of Kenyans are included financially. There is no doubt about it. But when you flip that question, how healthy are they financially? Last year, but 2, 3, 4 years ago, our financial health was about 21%. Financial health. Today, it's come down to 18.3%. So, as we discuss this matter, and as we ask many questions and we get many answers, there is a bigger elephant in the room. How do we ensure that inclusion is also really truly including and is empowering the people on the ground? So we can be able to have this discussion, and I really want to appreciate the questions.
Wow. So inclusion and impact. Someone you want to chime in?
Maybe just one or 2 points. My fellow panelists have said most of them. But from how I look at it, is that today we have banking is someone has to go probably to an institution, or you have to register an application, etc. But I'm wondering, and this will really require a lot of innovation in all the players of the sector. What would happen if we democratize the financial space in a way that agency banking came and did in the normal payment and receipts? What if we enable that local shop at Mandela, we talked of, or any other remote place, to be able to offer credit as a banking facility? And I want to believe that this will also enhance that reach where we need, and even the information. We want someone to be able to explain to that person who does not know what financial literacy is. And we cannot just do this thing online because, as you're saying, if someone is already in a remote place, the likelihood of this person probably having a digital channel is lower than someone who is in a urban context. So one thing is we need to innovate so much around how we avail our digital products or even the banking solutions. So on top of what fellow panelists have said, I still believe there is space to ensure that those guys who are in the talk, wherever they are able to access these services. And on top of just accessing, because it's beyond accessing, they're able to understand what they're putting themselves into. Because as you had David mentioned, if the financial health is going down, do you want to also impact now beyond even to those guys who do not have that know-how, to just enable them to have these loans and also increase the financial them not being able to take this massive.
So certain segments, especially bottom of the pyramid customers, seems like we need to do high-tech, high-touch. That's what I'm hearing from Samuel. So we'll move on quickly to our next question because time is ticking. Our next question is on alternative data. So we're using alternative data mostly to power our digital transformation. What data sets or models are yielding the highest accuracy?
I think then we go into the depth of scoring the persona, right? So I think first of all is, to David's point, we have to move beyond our comfort zones. We are comfortable scoring the salary of the employee, we are comfortable doing our schemes that are either guaranteed or non-guaranteed. But then there are creators in the space. We have a whole new demographic of Gen Zs that are not taking the traditional jobs. And if we do not go into champion challenger but with scoring in our organizations, then we're going to lose this demographic because we'll never be able to score them in the long run. So what does that mean? We have to move beyond transactional data sets into looking at behavioral data sets, and behavioral data sets going beyond traditional card behavior, incorporating social media, incorporating social behaviors, social norms, social interests, and how those pick the type of lending attributes that we need to have in our scoring models. But we also can incorporate psychometric data. I mean, I was listening to some of the presenters, some of the vendors that are out there, and then ending up with a hybrid model where you have both transactional data, which is traditionally what we're relying on, but then incorporating the psychometric data, but also the social data. What does that mean? It then creates a space where the fintech and the traditional FSPs can find a place of margin. And so we start to see the emerging of partnerships that allow risk-structured kind of partnerships. So for example, we're talking about telcos and banks, or we're talking about fintechs and banks. I keep challenging guys in the space, why are there over 50,000 digital lenders who still are struggling to form partnerships with banks? And it is value. So it's understanding the value and the role of each ecosystem there. So for example, let's say Caritas, what have they done that is so unique? They've got all these congregants that they've been able to look at and be able to develop a unique proposition for them. So if you're out there and you've got lots of young people in your space, you've got young people that you can see are putting money straight out of university, what kind of learning propositions are you doing? Are you designing for them? You've got data. We've all got data scientists in our respective organizations. What kind of modeling and data assumptions are they making to input into the product? So we've got to move from our standalone to hybrid solutions as far as lending is concerned. And also, let's take advantage of loan guarantees. If we're going to go into last mile, we've got to start incorporating loan guarantees into our embedded finance solutions.
So NPLs remain at 14% despite tech advances. How is the industry structuring partnerships the ones you talked about, to ensure that we manage risk within the industry?
Thank you very much. I think that's quite an interesting question. One, we're talking about 40%, that is NPL, non-performing loans. And those are your normal loans. If you go down to digital loan, then that's a different story. You can be able to get the picture when you look at it. What are we doing about it? One is to really use the value chain, particularly in the agriculture zone, using the value chain partnerships and be able now to de-risk the whole lending across the value chain based on the product itself. So as Caritas, we've tried as much as possible to have as many partners as possible, and along those partners, be able to create a strong backbone that is able to see each and every partner along that. Research has it that if you're able to have a very strong partnership, it de-risks your lending to a tune of about 15%. You're able to bring it down. So that's critical for us. It also enables us to train specific trainings along the value chain. So in terms of people, in terms of skills, we are able to focus on that. So from a Caritas perspective, value chains have really worked very well. And apart from that, value chain is also now to have a very strong partnership. And my colleague has mentioned, as Caritas, we work very closely with the church. The church has the structures on the ground. That's why when you ask people who Caritas is, we say kuimarisha jamii. We just focus on the family and ask what can we be able to do. To go back to what she was talking about in a few seconds, one of the biggest challenges we had in terms of putting the data together, the alternative data together, is how do we come up with alternative data that will not only look at that individual in that household, but will be able to aggregate and look at that household and be able to come up with a data with a household lending mechanism. Why? Because we've seen a lot of multiple lending, and it is causing a lot of challenges on the council. Household appraisal, household data sets, how do we come up with? I don't have an answer, but that is a challenge that I throw to you. Thank you.
Right. And then despite all the innovations, Kenya has come a long way in terms of digitization and financial inclusion, but yet over 80% of our MSMEs don't have access to formal financing. So while regulatory sandboxes do help, scale-up has been challenging. So what kind of government, private sector, or development collaborations are needed to unlock that demand? Someone?
I think there's need for a lot of collaboration, both in terms of working with regulators, because it's just scaling without looking at the risk. It's just opening ourselves to a lot of non-performing loans, as you mentioned in the previous question. Do we want to just measure our performance based on the number of loans that we give, or do we want to measure our performance in the impact that we have with our customers, or how best they are able to pay back the loans that they're taking? So I think there is a very big place that the regulators are playing to ensure that we are really, we are safeguarding that space, because I truly believe it's not just a matter of just dishing out money that you come, I've seen your investor statement, I've been able to give you a certain score and you have a limit. But the key question should be, are you able to pay back? Once I give you this loan, are you able to pay back? And I think that is where the regulators really come in, so that we do not move someone from where they are to a lower position just because we were able to give them a loan. But I really think there's a space for these players to work together, both the regulators, the partner, the likes of the credit bureau. Guys are now coming in that are able to now, as Lucy was talking about, to even have psychometric measures beyond the normal transactional statements that customers are sharing. It's So now you're able to tell that maybe someone, maybe based on their behavior, are they likely to be able to pay a certain loan? Because when you look at the whole way of giving out loans, it was probably, you want a mortgage, then you get a mortgage. You want a car, you get a car. So it's going beyond that. So now you're getting a limit, and then it's for you as the customer to decide now, where do you want to use this limit? It's no longer, it's beyond, the bit where it's beyond the product that the customer wants to buy.
Your final thoughts, I see our time is out. If you could mandate one digital lending product across Kenya, what would that be? If you could mandate one digital lending practice across the ecosystem, what would that be?
Right.
One or two words. Max 3.
For me, it would be a lot of partnership, and in this case is you've seen how guys do the advertisement online. You just log in into our website, and immediately someone is able to advertise to you a product that you didn't know you even needed. So that partnership for me would be great in a way that we are able to give you a loan that you didn't even know you needed, because we've already partnered with all these players in the market, and we are able to quickly make those decisions and offer you a product that you need.
This story?
For me, it's ethical practice. That's it. Ethical practice.
Very closely. Mine is productive credit. I think we keep giving money for the sake of giving money as lenders. Let's really give productive credit.
Yeah, so back to our homework question. So what after all the innovations? I think as we go back home, as we go back to our workplaces, let's try and figure out how we can impact, because it doesn't matter how much we do, how much technology we deploy, if it is not reaching those who need it most, then it's incomplete. Thank you.